John Mekwa, and this is Business Incorporated. Here's what we have for you for the next 25 minutes or so. And in Nigeria, poultry farmers are threatening to shut down because of unavailability of maize. Congo is set to get $43 million from the International Monetary Fund. And Egypt seeks finance aid from the United Arab Emirates for wheat. Welcome to the program. I'm Ini John Mekwa. As usual, we're headed into the market at this time, and we can tell you that at intraday, only the NGX was doing green. Other markets were in the red. I wonder what's driving them. It's a Friday. Is it profit taking on Friday? Well, NGX up there at 64,672 at intraday. South Africa, for a third trading session, is in the red, 0.26%, 76,819.19. We go to other market now. Egypt is closed today. They normally would not trade on Friday, but it closed 0.17% in the red, 17,578.67. Kenya, this is Thursday's closing number, in the green, 1.36%, and they left 111 to down there, 105.10 at the close of trade on Thursday. We move over to the Middle East, where it's mixed. And we know two of those markets are not open on Friday, just like in Egypt. Look at the numbers there. Abu Dhabi has Thursday's number, 0.37% in the red, 9,629.31. Dubai also, but marginally down, 0.04% at 3,986.36. Look at other markets. Saudi Arabia there. It's 11,755.94 in the green marginally, while Qatar is very much in the green, 0.65%. Well, let's move over to Europe now, where Germany, like many Western countries, has seen increased problems in its trade relationship with China. And now the government in Berlin has laid out its own official China strategy. We have joining us for this now, Lars Holter from Berlin, to talk to us on this. Hi, Lars. Good afternoon. So let's start from the beginning. What's the current status of Germany-China trade relations?
Thanks for having me. Yes, there are many obstacles facing these people, even as they deal with trauma from the ongoing war in their homeland. In terms of their ability to find employment here in Europe, including Germany, there are a few big issues. The first is bureaucracy and the unwillingness of some governments or agencies to recognize their certifications or vocational qualifications. That's left many new arrivals frustrated and sometimes stuck in jobs below their skill and education levels, and often with fewer longer-term career prospects. Another problem is a lack of childcare facilities. It's estimated that 70% of those who left Ukraine were women, and many brought children with them. In total, the OECD has said that Ukrainian refugees often face a, quote, triple disadvantage in terms of socioeconomic integration and finding employment. That would be gender, immigrant status, and forced migration.
Yeah, Cassandra, not last. Thank you so much for that. Well, moving on now, still talking about refugees, you mentioned there are skills that are common among them, mostly women. How do they match with what the country, Germany, how do they match with the needs there?
Europe has faced many acute labor shortages in recent years, and that has dragged on economic growth and fueled inflation. So the millions of people fleeing west from Russia's full-scale invasion could have been, and frankly could still be, a shot in the arm for many countries. Many of these refugees are highly educated, having worked in the medical or tech sectors in Ukraine. Data from earlier this year showed that people coming from Ukraine to the west not only were more educated than other refugee groups, but also that this refugee group is more educated than the general population of Ukraine. And it's a weird paradox. Here in Europe's biggest economy, United Nations data shows that Germany is hosting some of the highest numbers of refugees, but still, open job position postings have risen to their highest level since the end of World War II. So it would seem on the surface that there is a mismatch of skills. But there is some hope still that this puzzle can be solved. Germany, for example, has focused a lot on retraining training and language classes. It's possible that with many refugees now settling into life, even if it's temporary here in Germany, there may soon be fruit to show for months of classes, certifications, or paperwork filings.
Now, how are the investors behaving at the market today?
There was a bit of a wobble from Asian equities today at the end of a draining week. That's largely because of fresh U.S. jobs data putting revived bets on at least two more Federal Reserve interest rate hikes. That's added to ongoing worries about China's economy. Investors have largely been on the back foot since Monday. That's when we heard news that Beijing had missed second quarter growth targets, which indicates that a post-COVID recovery may be coming to a halt. This uncertainty in Asia followed a sell-off in New York, where tech titans were hammered after earnings reports from Netflix and Tesla disappointed.
All right, Cassandra, thank you so much for those updates. Have a great weekend. Talk to you on Monday. Let's move to other markets now. Asia, starting with we see that markets were mixed on Friday as investors digested Japan's consumer price index figures for June, and the country's core inflation rate, which strips off a cost of fresh food, came in at 3.3%, in line with expectations of economists before. Now, let's take a look at the numbers and see that the Nikkei 225 is in the red, 0.57%, 32,304.25. Kospi is on the flip side, 0.37% at 2,609.76. The Hang Seng Index is almost 1% up 0.78%, 19,075.26. I wonder if we'll have the other markets there. Yeah, Shanghai Composite is in the red marginally, so not so heartbreaking. And in Australia, it's also red, 0.15%, 7,313.90. In the United States, Wall Street features tied to the Dow Jones Industrial Average rose on Friday as quarterly reports from some of the biggest U.S. banks continue to roll in there. Taking a look at the number, the Dow Jones is in the green, 0.47%, 35,225.18. S&P, however, is on the flip side, more than 0.5% in the red, 4,534.87. The Nasdaq, wow, I think something is going on with the tech guys in the United States. It's down more than 2% at 14,063.31. But let's take a look at what happened, how the market closed on Thursday, and we have Maria Bird with those details.
The U.S. stock market was mixed on Thursday. The heavy tech Nasdaq was down by more than 2%, as this was caused by updates by Tesla of price cuts and Netflix earning reports. This has caused many investors to be concerned about the Nasdaq, while the Dow Jones was up by 0.7%, and this is mostly due to the stability of banks and also recent report by Johnson & Johnson of a 6% increase in earnings, while the S&P 500 had a modest decrease of 0.4%. The U.S. stock market was mixed on Thursday, but there's still major hopes for the days and weeks ahead, as the U.S. still looks to see if interest rate hikes will happen before the end of the year, but at this time they remain stable.
That's it from the United States. Let's head to the global oil market, where we see that oil prices rose on Friday, buoyed by evidence of tightening supplies and economic stimulus in slow recovering China. Brent futures were up 94 cents at $80.58 a barrel, rising as high as the dollar earlier, while U.S. West Texas Intermediate crude climbed 94 cents to $76.59 a barrel. The supply deficit had been looming in the second half of the year and is now backed up by hard figures. According to analysts, China and India's imports of crude oil from Russia hit an all-time high in June. However, buying interest from India is likely to weaken given narrowing discounts and payment problems. Meanwhile, in early July, Russia joined Saudi Arabia in cutting output for August. We head to the metals market now, where gold slipped from a 2-month high on Thursday as the dollar and bond yields ticked higher, although hopes for a pause in rate hikes by the United States Federal Reserve after July meeting limited the decline. Spot gold was down 0.4% at $1,968.84 per ounce after hitting its highest since May 17. Earlier in the session, U.S. gold futures fell 0.4% to $1,972, while the dollar gained 0.6% against its rival after the U.S. jobless claims data, making gold more expensive for other currency holders. Benchmark 10-year U.S. Treasury yields rose more than 3%, in fact, 3.85%. Data showed the number of Americans filing new claims for unemployment benefits unexpectedly fell last week, touching the lowest level in 2 months amid ongoing labor market tightness. Let's come to Nigeria now. And earlier today, during Business Morning, we spoke to egg farmers, and they are threatening to shut down if something is not done concerning the unavailability of maize, which has made it difficult for them to run their businesses. And we know that eggs may soon be scarce if they carry out this threat. They say they are asking for an intervention by the government. The Director General of the Poultry Association, Mr. Onalo Akpa, was our guest.
We want a deliberate attempt to actually look at the poultry needs, the poultry industry need of maize in this country. And I will quickly put it on record that the poultry industry alone need almost 4.4 to 4.5 million metric tons of maize out of the national maize production per annum. So, and I also want to put it on record quickly that, you know, when you have birds in this country, every day the birds clamor to eat food. And you cannot wait until something is, manna falls from heaven. So what we are saying is that if it is the enormous responsibility of a farmer to feed his bird on a daily basis for their birds to produce eggs. Now, what it means, invariably, it means that on daily basis, you need a lot of maize for the almost 90 million layers we have in this country, and then over 170 million broilers to feed them on daily basis. That is what we are saying. And if that does not come up immediately and we wait for the bureaucracy, then the industry may shut down, because you can't tell the birds that I can't get maize to feed you today, and then tomorrow the same thing. If I cannot feed my birds today, I cannot feed my birds tomorrow, and I cannot feed my birds next tomorrow, invariably, what you start having is we are going to have a complete decline in productivity, and eventually it will lead to death and mortality of those birds. And I will tell you right away that a lot of farms are already shutting down because they can't afford the high cost of feed. And I will tell you that for today, a 25 kilogram of a super layer mash, just 25 kilograms is going as much as 10,500. And when you divide 10,500 by 25 kilograms, you are having a kilogram of feed around 410 to 425 naira per kilogram. So a lot of farmers are not being able to be in business sustainably. And when those that are still there are managing to survive, because you can't kill the birds, you can't drown them, and you can't just abandon them because it's your lifetime investment. And that is what we are saying. The government has done much. They've been intervening by giving the association maize, and we are so astonished that in the last 6-7 weeks, we were given some quantity of maize by the Central Bank of Nigeria and the Nigerian Commodity Exchange. But within 2 weeks, before we could collate the requirement and the requirement of our various states and stakeholders, that allocation was withdrawn. So while we are crying is that we are not crying because we want only to be had. We are crying because we stand to provide the cheapest source of protein to Nigerians.
There you go. We need something to be done about that. Still in Nigeria, the Federal Inland Revenue Service has forecast that it will raise 7.5 trillion naira. That's about $9.5 billion in taxes in the second half of the year. And that's after a record performance in the first 6 months of the year as the government improves its collection processes. The Federal Inland Revenue Service has said that Nigeria Nigeria collected 5.5 trillion naira in the first half, surpassing the target of 5.3 trillion naira set by the government for the period. The executive chairman of FIRS, Mr. Muhammad Nami, told reporters that it raised 10.1 trillion naira of taxes last year and set a target to raise 25 trillion next year, 2024. I guess that means more taxes for you and I here in Nigeria. But let's take a break now. When we come back on the other side of Business Incorporated, we'll take a look at the currencies, how they're performing on the continent, the African continent. Is there danger looming? We'll talk about that in a minute. You're welcome back to watching Business Incorporated here on Channels Television. Now, the Kenyan shilling, Nigeria's naira, Zambia's kwacha are expected to weaken further in the next week by Thursday, while Ghana's CD and Uganda's shilling could strengthen. Kenyan shilling is expected to weaken further in the coming week, driven by demand for dollars from the manufacturing and energy sectors. In Nigeria, it's likely to weaken slightly as liquidity shortage in the official window persists, even after the central bank removed restrictions on the exchange rate and its intervention. Also, in Zambia, the kwacha is likely to continue trading weaker against the dollar as hard currency remains scarce amidst high demand from energy sector importers. In Uganda, the shilling is expected to post gains, however, on the back of inflows from non-governmental organizations converting their dollar holdings to meet month-end obligations. What does all this mean for the continent? We have Matt Kindiga, now practice leader with Sub-Saharan Africa with Front of You, joins us. Matt, hi, good afternoon.
Hi, good afternoon. Thanks for having me on the show today.
Great. So we see the different drivers in the different countries, and thank God it's not all bleak or bad story. But why is all this happening at this time? Is that something the continent is doing wrong? Everybody seems to be short on the dollar.
Yeah, so I mean, there are lots of factors that are driving currency volatility and, unfortunately, depreciation for many currencies. We're seeing a pretty broad trend at the moment. What we are seeing is three main factors. The first is quite high interest rates in the US and other advanced economies, including the UK and the Eurozone, and increasing signs that we're probably going to see at least another couple of interest rate increases, for example, by the Federal Reserve. And this does draw capital out of emerging markets, including Africa, and it does contribute to the strengthening of the dollar. So we are expecting this to continue for at least another 6 months or so. We also have quite high global agriculture and commodity prices for energy. So this is resulting in quite high import bills for many African countries. This is resulting in current account trade balance deficits, and this also pushes down currencies in the region. And then we also have some domestic considerations. So, for example, we have slowing economic growth, quite high inflation, and in some countries like Nigeria, rising inflation. And we also have concerns around some political stability. So, for example, in Kenya. So there are a combination of factors, not necessarily unique to Africa, but a number of things coming together to drive currency depreciation and volatility at the moment.
So with all of this at the back of our mind, what do we see as the outlook for major currencies, Naira, Rand, Shilling?
Yeah, so for the really big economies in the region, the takeaway, unfortunately, is there probably will be more depreciation for at least the next 3 to 6 months, pretty much across the board. So 2023 is going to be a bit of a difficult year for currencies, but next year is probably going to be a bit more stable, 2024. So when we look at the Naira, so we are expecting more depreciation of the currency, both at the official rates and at the parallel window. We do think the Naira is currently overvalued at the moment. There is very strong demand for dollars, so we do expect the central bank probably to allow the currency to depreciate very gradually towards the end of this year, but then stabilize into 2024 as the economy accelerates. In South Africa, a bit more depreciation and volatility as well. Really, the focus is on slowing economic growth there, linked to load shedding, as well as concerns over the country's political outlook, especially as we get closer to the election in 2024. However, we do expect the South African Reserve Bank to continue to raise interest rates to try to stabilize the rand. So depreciation, but volatility. And in Kenya's case, the rest of the year will probably see more depreciation of the shilling. We are expecting it to reach about 150 per dollar by the end of this year. But 2024 looks a little bit better. So we would expect central bank to raise interest rates, political stability to improve. So the current protests we're seeing in the country, which are economically disruptive, are probably going to wane. And there's probably going to be a bit of an uptick in the tourism industry. So a bit more of an optimistic outlook for the shilling in 2024.
Yeah, well, we hope the same for the naira. But how are businesses coping with all of this volatility in the currency?
Yeah, so there are two things to really think about. One is around pricing and margins, and the other is around forex availability and how this affects businesses. So the main takeaway, and for most of the multinational clients that we speak to and advise, and also companies operating in Africa, the impact of currency depreciation is really that it drives up the cost of imports and it reduces domestic purchasing power of households and businesses and even governments, especially when they're purchasing imported products. So this has an effect on margins, and companies are looking to deal with this either by raising their prices or increasing their prices more dramatically, or increasing the frequency of their price rises. This is quite difficult, though, at the moment, because of rising inflation or stubbornly high inflation in many countries, and this undermines customer purchasing power. So what we are seeing actually is many companies focusing on cost cutting where possible. So certainly a couple of strategies, either raising their prices or cutting their costs to deal with currency depreciation. And the other issue we're seeing at the moment is foreign currency shortages. So you won't be a stranger to it in Nigeria. We're also seeing this in Kenya at the moment, and it comes hand in hand with currency volatility and depreciation. The biggest risk it poses is payment delays for companies that are either overseas based and want to get paid from local partners and distributors, or if companies are being forced to access foreign currency in a parallel market that does raise their costs again. So certainly trying to work with partners or companies locally that have good access to foreign currency, also anticipating further currency depreciation and factoring that into your strategies for the coming year can help companies both with depreciation and forex shortages. So there's no silver bullet, but a couple of things that companies are doing at the moment to try to cope with this.
Yeah, well, everyone has to strategize to survive. But thank you so much, Matt, for sharing those views with us this afternoon.
Thanks. Enjoy your day.
You too. All right, now let's move to Egypt, where that country has criticized Russia's exit from the Black Sea Grain Exports Initiative and said that it will continue to import Ukrainian wheat even after the collapse of the United Nations-backed agreement, which of course happened this week. Egypt's economy has been slammed by an increase in grain prices since Russia invaded Ukraine last year, while global benchmark wheat futures had begun to moderate. They've surged this week after Russia terminated the export pact. Moscow has threatened that any vessel moving in Ukrainian waters would be considered warships. Although Supply Minister Ali Mouseli had noted that Egypt's strategic reserve of wheat are sufficient for 5 months, as the country has procured 3.8 million tons of wheat in the local harvest so far. Mr. Mouseli says that the country plans to continue receiving Ukrainian wheat via Europe. He also revealed that the government is in talks with the United Arab Emirates for $400 million in financing to help it purchase the commodity. The funding would come from Abu Dhabi Fund for Development via tranches of $100 million, according to the minister, but he did not say when the deal is likely to be finalized. We move to Zimbabwe now, where Zimbabwe's central bank has racked up debts of more than $4 billion to banks and companies, including commodities giant Transfigura Group and national flag carrier South African Airways. Those Reserve Bank of Zimbabwe debts relate to the supply of fuel, corn, and other goods and services as the state attempts to prop up the faltering economy. The Southern African nation is suffering from market turmoil as new tax rules drive a rebound in the currency, which was previously devalued to tame triple-digit inflation and the world's highest interest rate. The World Bank said that Addis-Djibouti corridor will get a significant upgrade with a $730 million grant following a newly approved Horn of Africa Initiative's Regional Economic Corridor project. The vital trade route and a lifeline for Ethiopia's 120 million people received $730 million grant from the International Development Association aimed at improving regional connectivity and logistics efficiency in Ethiopia along this key trade route, connecting landlocked Ethiopia to the ports of Djibouti. Improved regional connectivity and trade are essential to unlocking Ethiopia's economic potential, according to the Minister of Finance, Ahmed Shide. This project is important to support the commitment to foster inclusive growth and regional integration, as they are now fully focused on sustaining the growth and reaping the peace dividends. And the International Monetary Fund's Executive Board on Wednesday approved $43 million in economic relief to the Democratic Republic of Congo. The IMF said the funds will help political leaders in Congo implement their development policies, maintain macroeconomic stability, and strengthen economic recovery amid high food inflation, lower oil prices, and tightening financial conditions. In March, a World Bank report titled The Republic of Congo's Road to Prosperity, Building Foundations for Economic Diversification, showed that the Republic of Congo's oil-driven growth model has reached its limits, and sustainability development urgently required efforts to diversify national assets, focusing on stronger institutions, development of human and physical capital, and a more balanced exploitation of natural resources. And that is what this loan is aimed at. That's it on Business Incorporated. Thank you so much for being a part of it. I'm Ini John Rekwa. Do remember to join Ladi Williams on Saturday, 7 p.m. for Capital Market to get a summary of what the market looks like all through the week. Have a great weekend.